Hi, and welcome back to Protect and Invest with Marsha. So today we're going to talk about one of the most important protections that you can put on your family. And yes, we're talking about life insurance. Dun dun dun. Okay, I know that life insurance is sometimes not the most popular topic to discuss, because to think about life insurance is to think about death. And guess what? It is what it is, right? Life insurance is protection for when you pass away, right? Or if you pass away prematurely, okay? And the way it works is that life insurance is not necessarily for the person that is taking it out on themselves, for instance, who's taking a policy on them. It's really to leave behind for your family, right? For those who are impacted financially if you are to pass away, like your wife, your husband, your children, anyone depending on you as a breadwinner for the household, okay? For the most part, that's the basic way to see it. If you don't have maybe dependents or people who are depending on you for income or to survive in this world or in this life, then yeah, you probably do not need life insurance. Not everyone needs life insurance. Some people are wealthy enough to be self-insured. But for those of you who do find yourself in that situation where, hey, if I pass away, my family's not going to do too well on their own to cover the mortgage, to pay for any remaining debts like car loans, student loans, or anything that can impact them, then you need to take out life insurance as soon as possible, because there are two main factors that go into the cost of insurance. All right, life insurance. Those two factors are age and health. The older you get, the more money it is, and the more unhealthier you become, the more it becomes as well. The more expensive it becomes, the higher the cost or the rate is. All right, insurance companies need to assess your risk before they can offer you insurance, okay? And so it's important for you to understand that the younger you are, the better off you are in getting life insurance. Specifically, if you're a young family, maybe you're in your mid to late 20s or you're in your 30s, and you say, hey, I'm just starting off my career, I'm not where I want to be financially yet with my family, this is probably the time that I need to go ahead and get life insurance, so that in the event of a premature death, meaning you may pass away before the average age of death. For women it's 80, for men it's 77, your family's protected, okay? I hope I clarified that as clearly and straightforward as possible. So now that you've determined that you need life insurance, there's something you need to know that oftentimes people are not aware of. There are three main types of life insurance that people obtain, okay? It's term life, whole life, and universal life insurance. Now you're like, whoa. That's already a lot. I just need life insurance. I know, I get it. But the purpose of this video is that it's educational information so that you can make the best decision for you and your family. All right? So first and foremost, you have term life insurance, okay? Term life insurance is the most basic and most affordable type of life insurance there is out there. Okay, all it is regular insurance that operates like many other insurances, right? Term insurance covers you for a period of time, okay, for 10, 20, 30 years. If you were to pass away within that term, your family or your beneficiaries, whoever you have as a beneficiary, they would collect the coverage amount, okay, or the face amount or the policy amount that you applied for, that your policy will provide, okay, whether that was $100,000, $200,000, $500,000. Your beneficiaries will get that money if you're to pass away within the term or the period of time, the period of coverage that you would have, and that's it. Next, you have whole life and universal life. Now, those two types of insurance are different than term. They're considered what you call cash value insurance. Now, cash value insurance is more expensive, or it costs more than term life insurance. And the main reason is because they have two elements to them that your payment goes towards. Your payment goes towards the insurance coverage, which is, let's say, for instance, $100,000. You have $100,000, coverage amount, and then the other portion of your premium payment or your monthly payment will go into an account called cash value account. That cash value account is a very conservative yielding account. Okay, the rate of return on a cash value account could range between 1% to 3% or so. All right, and that's very low. That's very conservative when you think about the financial world and what you can get elsewhere. All right, but nonetheless, it is an account. And also the difference is that with whole and universal life, they're also considered permanent life insurance, meaning it's insurance until you die, right? Or until you die up to the age of 100. How about that? That clarifies it, right? So you have until 100 years old to pass away, okay? And if you, let's say, pass away, your beneficiaries will likely just get the coverage amount. The cash value account, similar to a savings account, but like I said, it generates a very conservative interest on it. That account does not go to your beneficiaries. That cash value generally stays with the insurance company. All right, and you may be saying, what? Yes, this is something that you can do your own research on to see for yourself, but 10 times out of 10, your cash value money is not going back to you. All right, it's not going back to your family. Now, if you are to survive at 100, right, and you're no longer insured at that point, then you keep the cash value. All right, you keep the cash value. The cash value will grow to the same amount as your policy amount or your coverage amount. So if you take out a policy for $100,000, by the time you turn 100, if you survive that long, you will get your cash value, and your cash value would have grown to $100,000. And it is the responsibility of your insurance company to ensure that you get it in that amount. Now, with all of that said, I hope you can understand that these insurance types are different in their unique and respective ways, and you understand the pros and the cons of each of them as well. Now, I am very much a fan of term life insurance if you see it as a temporary vehicle by which it allows you enough time to become financially stable so that you no longer need it. All right, that's the goal. Is I want to be financially independent so that I no longer need life insurance, so that I then become self-insured and have plenty of money, plenty of financial resources for my family to survive if something was to happen to me. All right, so if I were you, do your research, think about these things. If you want more information, if you want to book a session with me for a financial services overview so you can make your own decisions, then please go ahead and book with me, and I would love to get in contact with you. Thank you for joining me.